Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update for Friday, December 16th. Well, the big item of business news this week was the Federal Reserve meeting on Wednesday. They announced another interest rate hike. This time they cut it from 75 basis point hike to a 50 or 0.5% hike. Nonetheless, that was expected. And even though it was expected, stocks have struggled since that announcement. We're lifting up in the first half of the week and then tailing off pretty substantially in the second half of the week. In our last update, we talked about our market model moving back to a buy signal on November 30th. However, our economic model continues to be negative and all of that remains the same. We are going to be able to update you on our market valuation model today because we got the latest data to show you how stocks are valued as of this point. So with the market model positive, the economic model negative, we pointed out that there's some cross currents there. And it's a pretty rare condition, but when that happens, we want to move with the market model. We want to do it cautiously, but we do want to get in position in case the market begins to trend higher. We did point out there's a good chance that there's a false signal here with the economic model negative. If this buy signal is going to stick, we would expect to see market strength to build very soon, between now and the end of the year. So the latest pullback in the market looks a little ominous, right? But we also want to point out that this is a major option expiration week. This is quadruple option expiration. It's the largest dollar amount of option expiration in 2 years, and oftentimes the second half of option expiration week is more volatile than usual and creates more violent moves in certain directions. So we'll see if that unwinds as we get into next week. And of course, we'll be getting into the holiday season, and oftentimes the Santa Claus rally that they talk about oftentimes begins next week. So let's take a quick look at our PAS dashboard. We could see that the arrows are pointing up as of that buy signal. However, nothing material has changed with our core indicators in the last couple of weeks to discuss this week. I do want to take a look at the overbought, oversold indicator. And we could see just a short period of time from the November 30th buy signal through yesterday's trading. The market is in the bull trend channel, but is hugging the lower end of that channel. It's failed to lift off and really sustain an upward trend since that buy signal. Bringing in a little bit more history, going back a year or so ago, we could see how this particular indicator has been choppy, with first the model being on the buy signal that had been in place since the COVID recovery, and then went to the first sell signal, a brief buy signal, which you could see just kind of touched the upper end of the bear trend channel, lower end of the bull trend channel, and quickly receded. And now this time we're into the bull trend channel, and it's easy to say, well, if this one failed, this one's going to fail too, but I wouldn't jump to that conclusion so fast. We are in a seasonally very strong period, as we've discussed in the election cycle, and we're smack dab in the middle of that seasonal strength. So we have to give this a little bit of time to see if the buy signal is going to develop. But we would say it's probably a 50-50 chance that it develops into some sort of upward trend. It could be a short opportunity. It could be a longer opportunity. It really depends on the path of the economy, which we're going to talk about in a minute. At the same time, if the economy begins to slow down much sooner, then this is likely to be a failed buy signal, and we know that that's a reasonable probability. So we've moved cautiously. We've moved with some hedges in place too to protect some of the downside in case the market begins to deteriorate quickly as it did during this period. Now, why do we want to move in the direction of our market model when the economic model is negative? Well, I think this graph shows a good demonstration of why. We're going back in time here to a previous significant bear market in the year 2000. You could see somewhat similar action as what we saw this year as the market began to change from the previous bull market to the bear market, and there were a few times when these temporary buy signals took hold as the market was rallying. They failed to materialize. However, the fourth time that the buy signal took hold, a major uptrend began. And we're looking at about a 4 to 5 year uptrend and a significant market opportunity. So we don't know which buy signal is going to begin that next major market opportunity. And taking some risk, knowing that we could lose a small amount of capital during these short periods, is a good risk-reward trade-off, because when the positive trend develops, we should make significant capital to the upside. So going back to the current cycle, we'll continue to take the same approach. When we get buy signals, we want to move in that direction. If our economic model wasn't negative, we'd be moving aggressively. However, with that being negative, we know bear cycles could take longer, they could go deeper, and we haven't seen the recession yet. So more than likely, we haven't seen the last sell signal in this particular bear cycle. Well, let's switch the discussion to talk about some of the economic modeling. In our last update, we showed you this chart, which is comparing the effective Fed funds rate to the 10-year Treasury rate. And we showed the importance of the crossover, where the Fed funds rate, which is what the Federal Reserve controls, is now higher than the 10-year Treasury rate, which is a supply and demand market-based rate. Well, for some reason, they haven't updated this chart for the latest Fed funds movement. So we now know that the Fed funds is another 0.5% higher. So let's call it 4.33%. We know the 10-year Treasury rate is right around that 3.5%. So now we have even a bigger inversion of that yield curve. So what's such a big deal about an inverted yield curve? Well, this is a longer history of the same chart. And it's very obvious that when the orange line goes above the purple line, that's the higher Fed funds rate than the 10-year. To follow is a recession, and those are the gray shaded bars. Almost every time that happens, we get a recession. Now, the lead time of when that recession occurs, in other words, when this yield curve inverts and how long it takes for the recession to follow, is going to vary from economic cycle to cycle. What I find somewhat interesting here is that if we look at back here in the 60s, 70s, early 80s, when there was a long-term increase in interest rates generally, when the yield curve inverted, both were rising. It's just that the Fed funds rate rose faster than the Treasury bill rate, right? You could see that through here. Since the peak in interest rates in the 1980s, early 80s, and the very long slide, when the inversion took place, it happens with a declining 10-year Treasury and an increasing Fed funds rate, right, every time. Well, that's what we're seeing taking place right now as well. Let's go back to the year-to-date here, and we could see the 10-year Treasury rate is declining while this one's increasing. So perhaps that means that once this inflationary period is over, we're going to go back to potentially a longer deflationary type of period, what was in place prior to the pressures that push costs up more recently. We'll see if that materializes. That's not really a major influence on decisions that we're making today, but it's an observation that we'll want to monitor in the future. Here's another way of looking at an inverted yield curve. This time we're comparing the 3-month Treasury rate to the 10-year Treasury rate. And once again, you could see in this case it's the purple line being the shorter term rate and the 10-year rate being the longer term one, declining while this one's still rising or holding steady. And a pretty good inversion there. That's almost 1%, where that 3-month rate is above the 10-year rate. Some people like to use the 30-year rate as the long-term one. And again, you could see the same thing, where the 10-year and the 30-year is very similar, and the short-term rate is well above it. And others like to use the 2-year rate as the short-term rate, and we see that also is inverted, where the 2-year and 3-year and 3-month are very similar, and the 10-year and 30-year are also very similar, but both dropping and both lower. So we have a really thorough inversion of the yield curve at this point. Well, why is all this important? Well, if we go back to the history of the 2-year versus 10-year yield spread, whenever it inverts, as noted by a drop below the red line, a recession follows, right? So we get an inversion and there's a recession. Inversion, recession. I mean, even during COVID, it got very close, and most people think that was a different type of recession, but maybe we were headed that way anyway. But now we could see a major inversion, the biggest inversion going back to the 1980s. And a similar look with the 3-month versus 10-year. When there's an inversion, generally speaking, a recession follows. What we notice is a little bit less lead time. This tends to happen a little bit closer to the recessions, and during the COVID recession, this one did invert prior to the recession. So we're now at a very steep inversion, as we could see. Now, I bring this all up because this is part of our economic model too, but along with a lot of other angles and looks at the economy, but this is one. And I think a lot of people use this type of indication now compared to the past. And what we're finding is everybody expects a recession. It's the most widely expected recession by far. So the market has a tendency to, fool the majority of people. So if everybody expects a recession, how could we get a curveball thrown to us? Well, a couple of things I could think of is, one, the recession could happen much later than people think. If it doesn't happen for, say, a year or so from now, there's a 6 to 9 month window that stocks could rally, because the market tends to peak usually within 3 to 6 months before a recession, not a year and a half before a recession. The stock market peaked in January this year. We haven't had the recession yet, so we're coming up on a year potentially before the recession would start. Not likely to happen. So that's one surprise that could develop. Still a recession, but not for quite some time. The second thing I've noticed is, while most people expect a recession, almost everybody follows that up by saying, but it's going to be mild. Well, what does that mean? What if it's not mild? What if it's a recession, but people expect it to be mild and it's a severe recession? That could go in the other direction in terms of its implications on the stock market and the economy, of course, and just asset prices in general. If it's a severe recession and it happens around the time that people expect it, you should see significant pressure on corporate earnings, significant unemployment, and that should materialize into significant decline in stock prices still to come in this bear market. Now I want to change the discussion to look at our market valuation model. We got our latest read on this. It's now updated through September 30th. And what we continue to see, of course, is a decline, right, in market valuation. So starting the year out, we were up here at the all-time high. We've now come down for 3 quarters in a row. Through September 30th, stocks dropped through the first 3 months of this year, and we've seen the valuation of stocks drop. We're now getting closer to what we would say a fair value, right? We're no longer at the upper echelon of market valuations. We're certainly not down near the levels that we would expect stocks to boom for the next 10 years, but we're in a much more reasonable valuation. The action, though, the slide looks somewhat similar to what happened from previous peaks, right? From the 2000 period, the previous all-time high prior to last year's all-time high, and then back here in the 1960s. That first few quarters were very negative. So we could use these two cycles as some guidance as to how this one might play out. And what we would expect is, at some point, we don't know when, but at some point, that initial decline in valuations runs its course, and you get what tends to be a reasonable 2 to 4 or 5 year period where valuations start to go up again. And that is a bull cycle within a longer term depression of market valuations. Right? You saw the same thing here develop, say, from the early 70s into 1973, 74, something in that range before the next leg down in valuations. Same thing happened here from the bottom in, say, 03 to the high in 07 before the next leg down in valuations. So we don't know if we're there yet, but at some point we will be, and we need to be on the lookout for this, right? Because we would expect our model to give us one of those buy signals, just like it did here a couple of weeks ago. Whether it's this buy signal or it's one in the future, we don't know. But when that opportunity develops, it could be a window of opportunity to grow portfolios and accumulate more wealth in what might end up being a longer period of generally declining or weak stock prices, right? Like it was from 2000 to 09, like it was from the late 60s to the early 80s. Those are long periods where stock prices were on the decline, but you get the shorter opportunities in between, and those are the bull cycles where wealth accumulation opportunity develops. So we'll be on the lookout for that. But the point here is we're off of those all-time highs. We're at more reasonable valuations. We're certainly not at low valuations where we would expect a strong decade for stocks to follow. But we could at some point get to a more reasonable valuation that could be the liftoff for a bull cycle. We'll continue to monitor and watch and use all of our tools to try to identify that opportunity. So in summary, not a lot has changed with our models. Market model, still on that buy signal very early, only 2 weeks into the signal. Typically, false starts start to rear their head very early. Right? If it's going to be a false start, we would expect to begin to see that in the next couple of weeks. If this buy signal is going to stick, we would expect to see that in the next couple of weeks. From an economic standpoint, nothing's changed there. Everything's still pointing down. But we could see market values are a lot better. Right? Buying today, you're getting a lot better value than you were, say, December 31st of last year or the very beginning of this year. So that's going to wrap up this update. Obviously the last one here before Christmas and the holidays. So I want to wish you all happy holidays, Merry Christmas. I hope you have an enjoyable season with your family. We'll be back for a year-end wrap-up in 2 weeks.